Fixed mortgage rates are getting pushed higher again, and it's happening fast. Oil prices are jumping, global tensions are rising, and markets are reacting instantly. If you're waiting for the perfect rate, this might be one of those weeks where waiting could backfire. Hey friends, Becky here. Welcome back to your weekly mortgage update. Let's break down what's happening, why it matters, and what you should be paying attention to this week. All right, the big story is this. Bond yields are climbing, and when bond yields climb, fixed mortgage rates follow. So why are yields moving? One word, oil. Oil prices jumped sharply this week as conflict in the Middle East escalated. And here's the thing, when energy costs surge quickly, markets immediately worry that inflation could heat back up. Higher inflation risk equals higher bond yields. Higher bond yields equal pressure on fixed mortgage rates. Some lenders have already adjusted their fixed rates upward by about 5 to 10 basis points. If oil keeps pushing higher, we could see more of that. Now, on top of all of this, the Bank of Canada delivered an interesting message this week. They basically said inflation isn't just about demand anymore. We're now dealing with supply side pressure, things like trade friction, geopolitical conflict, labor shortages, severe weather, global disruptions. All these things can push prices up even when the economy itself is soft. The bank is keeping its 2% inflation target. That's not changing, but they are acknowledging that getting back to 2% is becoming more complicated. That's important because it explains why rates aren't dropping as quickly as people hoped. Even a sluggish economy can still have stubborn inflation. Here's what the numbers say this week. Canada's services sector is still weak, productivity remains soft, and our overall economy looks sluggish. But the US continues to come in stronger than expected. And because our economies are so tightly connected, stronger US data can push our yields higher too. So we've got weak Canadian data, plus strong US data, plus rising oil prices, plus global tensions. All of it equals upward pressure on fixed mortgage rates. A rate cut on March 18th is highly unlikely. Markets have basically written that off. The bigger story is fixed rates. Bond yields moved higher, lenders reacted, and if the oil inflation story continues, that pressure could stick around for a bit. The Bank of Canada is still committed to 2% inflation, but supply shocks are making the path messy, and fixed rates can rise even when the economy feels slow. So if you're renewing or shopping right now, this is a good moment to be proactive. Not panicked, just proactive. Waiting for the perfect rate in a volatile week like this can sometimes work against you. Thanks for being here. I'll see you next week.